or manage your personal finances? Your search stops right here. Join Mukonke Mukonkela from Inside Partners Africa every Tuesdays at 07:30 hours on the Ndalama Insights Business Show, a program that gives you the best and most practical, actionable insights. So, good morning and welcome to another enlightening episode of Vandalama Insights. So, that's your source for valuable business and financial advice. I'm Leslie Sinyangwe, your host, and today we have a topic of utmost importance. And I think this is one of the most important topics we should be talking about in Zambia. That is the roadblocks that debt presents on our path to financial freedom. Joining us is our esteemed financial expert, Mukonke Mukonkela. Mukonke, good morning and welcome to the show.
Good morning, Leslie, and good morning, listeners. It's a pleasure being here with you this morning.
Okay. Now, today is very critical. I think this is a very important topic that is breaking free from debt and achieving financial freedom. Let's just dive into this right now. Konki, let's start by examining how debt can hinder individuals from attaining financial freedom. Could you clarify which types of debt often become significant obstacles?
Thank you, Leslie. So, when we're talking about debt, I'm sure you've heard of people saying you can use other people's money in order for you to build wealth. So, when you hear that phrase, you need to think about good debt as well as bad debt, because there is indeed debt that can help you to build your wealth, and that is what we refer to as good debt. And that debt is normally at a fixed interest rate, is at a interest rate that is affordable to you, that you can repay back, and is debt that you are going to use to buy assets that are going to enable you to grow wealth as well as repay back the principal and the interest on the loan or debt that you are acquiring. So that is a good debt. But there's also bad debt that people need to be aware of, that actually creates a burden or a stumbling block to attaining your financial freedom, even to building the wealth that you want to build. And this debt includes high interest rate debts, personal loans, getting loans that you are going to use for consumption or for buying household goods, debts that are not going to make a return. So those can be burdensome, and we've seen quite a lot of people even considering suicide when it comes to the burden that this kind of debt creates. And so these uh, bad debt is a debt that can actually create an extra drain on your financial resources and result in a lot of stress. So it's important that we are aware of these different types of debt.
Okay. Thank you for clarifying that. Now, moving forward, what strategies do you recommend for individuals being back on their journey to financial freedom by conquering debt?
So when if you want to attain financial freedom, Leslie, you will need to create a plan in terms of how you tackle your debt. Yes, it's true, you might have quite a number of debts that you've borrowed that are high interest, but it's very important that you actually list all the debts so that you are clear in terms of how much you have in terms of the loans that you've borrowed. How much do you have? So list all your debts, the principal as well as the interest rates, also itemize them, and also note the minimum payments, monthly minimum payments that are required on those debts. Don't forget debts that you also just get from your friends and family as well, because those can also be an important element of your debt structure, or the number, the amount of debt that you've incurred. So once you've itemized this debt, then you need to create strategies on how to start repaying those debts. And if it's a good debt, I'm hoping that it's already giving you a return, money back on the principal. So that should be able to allow you to afford to repay back the loan. But then create a list of all the debts, and then consider repaying back the high interest rate debts. For me, I would focus on tackling or dismantling debt that has high interest rates, especially if it's a variable interest rate. A variable interest rate simply means that the interest rate is not fixed, and it will change depending on changes in the monetary policy. Recently, we've had the Bank of Zambia increasing the base rate. So if you've got a variable interest rate loan, that automatically affects the amount of interest you're going to pay on this debt. So for me, my focus is on paying debt that has high interest rates, once you're able to dismantle that debt, then you can start dismantling other debts also. So those are some of the few strategies that you can employ as you embark on creating a feasible financial plan for your financial freedom journey.
Now, turning our interest to high interest debts, can you elaborate on how they impact an individual's overall financial well-being?
So high interest rates are those, I mean, in Zambia, we live in a country where our interest rates, even on personal or commercial loans, are not less than 29%. And these are debts or loans that really compound in the long term. So if you are not paying back, or if you are not able to make a return on the loan that you've borrowed, you're actually going to compound or double the loan that you have. And this makes it really difficult for you to promptly pay back that debt, or comply with the minimum monthly repayment plan. And as a result, this can result in an increased burden on you. So this might even affect your investment plan or even achievement of your financial goals. So that is what high interest rates do in terms of a person's financial plan, or their aim to achieve financial freedom. So it's very important that you have a clear plan in terms of how you handle these high interest debts. Um, yeah, if possible, like I always recommend, consider other alternatives, and we're going to look at those very soon.
Okay. All right.
Mm.
Today we're talking about breaking free from debt and achieving financial freedom, which I think is a topic that really does need to be discussed. And we'll take a short break now, but you are still listening to the Ndalama Insights radio show, and of course, with me on the show is Mukonki Mukonkela. Remember, if you do want to watch live, you can also search on YouTube. That is simply search for Mukonki Mukonkela, and you should be able to take part in the show as well as it happens live. We'll take a short break. We'll be right back. You are still listening to the Dalama Insights Business Show, brought to you by Insight Partners Africa. Leave your comment or question on Mukonkela's YouTube channel. The Dalama Insights, turning your challenges into actionable insights. Thank you for staying with us. And of course, you are still listening to the Ndalama Insights radio show. And with me in the studio is Mukonke Mukonkela. Remember, you can follow on YouTube as well. Simply search for Mukonke Mukonkela. The central bank recently increased the monetary policy to about 10 basis points. That's what they're called, right?
Mm-hmm.
I'm getting the hang of this. So the 10 basis points. That is by 0.5%. Let's talk about how a central bank's decision to increase monetary policy can affect an individual's debt situation.
Thank you, Leslie. It's very important to be observant of what the central bank is doing. And normally, the central bank's decision, in our case, this is BOZ, to increase the base rate often results in increasing interest rates as well on any loans that you have, personal or commercial. And I think I heard an announcement from quite a number of commercial banks announcing that effective 1st September, there's going to be a revision of the bank interest rate. So this is an automatic trigger whenever a central bank revises the base rate upwards. This is what we expect. We expect interest rates to go up. Now, this directly affects the loan that you have, because obviously it's going to increase as a result of the interest rate going up. And for individuals, especially those that have variable or loans, interest rate loans, it becomes an extra cost that you need to consider, and also create a plan for in terms of how you are going to repay back. Suggestions are normally lengthening the repayment period. So if you had a 12-month repayment period, you could consider increasing it maybe to, you know, 18 months, and all of that. So those are some of the strategies you can implement, but then also consider that the longer it takes you to repay back the loan, the more expensive it actually becomes, or the bigger it actually becomes. So that is the effect of the central bank's decision to revise a base rate.
It's an
Mm.
important information to understand. Now, considering the impact of rising interest rates, what options should individuals explore when faced with high interest rates due to central bank policy changes?
So if you're in business and you've got a business loan, I think my best advice to you is also consider probably looking at the prices of your goods or services, because if you've borrowed a commercial loan, we expect that you are utilizing that loan in your business to make more money out of that loan. So the best way is to maybe look at revising your prices so that you can also transfer that cost of the interest rate to your customers. So that could be an option. But most importantly, I think you need to start by reassessing your situation. Sit down with your bankers, look at affordable and ways in which you can repay back the loan that does not have an adverse impact on your cash flow, because at the end of the day you still want to be able to retain some income and also be able to repay back the loan. So sit down with your bankers and agree a feasible repayment plan. But also in the long term, even before you get a loan, you need to really assess if you're able to repay it back, and also consider how you are utilizing that loan. Don't get consumer loans where you are just going to use it for maybe buying a nice TV that connects you to Netflix and YouTube. Consider getting loans that you're actually going to use for investment, because that way if you get a loan and then you spend it in maybe buying an asset that is going to make more money for you, that is a good investment of that loan. And also just calculate to check if the repayment, the interest rate, the return on that loan is going to give you a higher return than the interest rate. So those are the things that you need to consider very carefully when you're getting a loan. If at all you discover that you cannot make a return which is higher than the interest rate, I would consider you start focusing on building an emergency fund, slowly saving money, setting aside money. That way you're building money that we call an emergency fund, which you can then tap in when you really need money to utilize for whatever you want to utilize for emergencies, or even maybe tapping into invest in a certain business area. That's another way you can actually start looking at this. So consider building an emergency fund. That way you don't have to rely on seeking financing from financial institutions or even shylocks, which are even more dire and severe in terms of eating into your cash in order for you to attain financial freedom. So that is what I would suggest, Leslie.
And
Mm.
now, lastly, Nicole, could you shed light on how being proactive about debt management can prepare individuals for potential shifts in monetary policy?
um, so being proactive simply means that you need to be able to assess the economic environment. And nowadays we live in an ever evolving business landscape. Not so many things are certain. So you should be able to read the economic environment. And that way it will guide you in terms of how you make your business or even personal decisions in terms of borrowing. As I've said already, if you've assessed the situation and you find that you will not be able to repay back the loan, it is advisable that maybe you reconsider and look at other options. Okay. But then again, also for me, I would suggest that whenever you are making a decision to borrow money, always consider, am I going to make more money if I get this loan? How much more am I going to make? Will I be able to afford to repay back, the way this financial institution, bank, or whoever wants me to repay back? So consider those things carefully, and also consider investing in assets that are going to give you a return. So those are the considerations you need to look at. And if possible, when you're getting a loan from a financial institution, and I know this is pretty hard, consider getting a fixed interest rate loan. I don't think this is common in Zambia. Most of our loans are variable interest rates, meaning they change regularly in accordance to the Bank of Zambia's policy rate. So if it's possible for you, if you've got good negotiation skills, always settle for a fixed interest rate loan. That way you are protected from any fluctuations that are happening in terms of the base rate. Mhm.
That's interesting. I know you're an accountant as well. So, one simple question: if you're paying back a loan and they put basis points, the 0.5, and you go there and you say, okay, now you're trying to decide whether you're going to add tenure or you're going to let them increase what you're paying back. Um, if you add tenure to a 5 year loan, how much tenure are you looking at for a 0.5%?
If you've got a 10-year loan and you
For
want
a
to
5 year loan.
five
Yeah,
five year
increasing
loan,
by 0.5%.
and the interest rate has gone up by 0.5 basis points. So how much more do you want to lengthen the repayment period? Is that your question?
Yeah, is it by months or do they lengthen it by years? What?
It's normally months. It's normally months, but it all depends. So you will need to recompute the rate, the interest that you're going to now be able to pay with the increased interest rate, and then it's all up to you really. You can even extend from 5 years. You can extend to 7 years, but look at the overall interest rate that you're going to pay at the end of that period, because the longer it takes you to repay back, the more you are going to repay back in terms of the interest rate. So it's really up to you. And you can decide not to increase the tenure of your loan if you don't want to. So it's really up to you.
Yeah, because I've noticed sometimes when you do want to do that, they'll add a tenant quite, depending on what you got as a loan, 1,000.
Yes,
It practically depends on what you got as a loan. Huh?
yes, it does.
Very interesting discussion because I know by the 1st of September, I think all banks are basically going to increase their interest rates. So it should be an interesting
Yeah, I think next week maybe we could consider an actual example of a loan and what that will result into in terms of the impact of the increased interest rate, and if we lengthen the repayment period, how much more will you need to repay back on top of a certain amount loan? Maybe we'll look at that next week.
definitely.
Yeah.
Thank you very much, Makoki, for coming through to the show and sharing your expertise with us on breaking free from debt to basically achieve financial freedom.
Thank you so much. And just the last word, Leslie. I know a lot of people are burdened by debt. Considering suicide should not be an option. Always call somebody, talk to someone. It's very important for you to talk to someone. And we should be ready to listen as people. We shouldn't condemn individuals that are indebted. There's a reason why that happened. So we should be able to listen, but also those that are indebted, be willing to share with a colleague. A problem shared is half solved, isn't it? So that's my encouragement to you, my listeners, as well as viewers. Thank you so much.
Definitely. And people don't underrate the power of debt and how debt is one of the biggest causes of suicide as well.
Yeah.
Makoki, thank you very much for coming through this morning.
Thank you so much.
Right. To our listeners, remember that understanding the intersection of debt and monetary policy is vital for securing financial stability. So stay tuned for more enlightening episodes of Dalama Insights. Until next time, empower yourself on your finances.